Asian stocks rose, led by Japanese shares as a result of a steady yen. Oil prices eased in early trading after a 3% jump in the previous session, as investors kept an eye on widening conflict in the Middle East that could tighten global crude supplies. Investors are now turning their attention to a pair of inflation reports that are due over the next couple of days on consumer and producer prices. The data could give an uncertain market some direction after last week's wild moves following a disappointing jobs report, as well as the unwind of the yen carry trade, which rattled investors. Later this week, retail sales data could garner some attention after the latest jobs report revived fears of slowing growth and put the consumer under the microscope. Elsewhere, corporate earnings season continues with results from major retail bellwethers. Looking at the all-share index, that's down 0.3%. Financials down 0.1%, industrials down 0.5%, resources also in negative territory, down 0.3%. Emerging market currencies have firmed further after last week's sell-off, with the rand trading back at 18.19 to the dollar, 19.86 to the euro, and 23.26 to the pound. To help us make sense of the markets, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. I mean, you look at the stomach-churning events of last week, Monday, and then we had this bounce-back rally on Thursday. Yesterday, we kick off the week as though nothing happened. How are you making sense of the past week coming into this week?
You know, to think about that, last week, as much as it was volatile and it was a short week for us, we managed to finish the week up 1.4%. But yes, it seems as if panic is fading. But unfortunately, if history is any guide, then we expect the markets to continue to be jittery for some time. And remember that old relationship or traditional relationship between bonds and equities in the recent years that has been put into doubt, but it seems to be coming back, where you get fixed income offsetting losses when it comes to stocks.
So I mentioned that we've got data coming out this week, PPI today, CPI tomorrow, but let's focus in on that CPI print. How important is it in relation to perhaps Friday's or rather Thursday's retail sales data?
Very important, because we know that the U.S. Central Bank, they've got a dual mandate, that is employment and also to maintain inflation, to make sure that it's within check. They've got a target of 2%. So hence the inflation print continues to be more important compared to retail sales, which are also very important, because that also tells you how the economy is doing, given that more than 60% of the economy is driven by consumer demand, and retail sales happens to be a very good indicator. But for us, those numbers, they will be telling us whether the guys will probably maybe try to front load when it comes to interest rate cuts in order for them to try to achieve that soft landing. And I'm mentioning that to say that last week's volatility, it was mainly driven by the fact that people were thinking that the US might go into a recession. We know that the yen carry trade also contributed, but there were some recession fears. So we're not sure whether the guys will want to front load in order to achieve that soft landing or not.
Okay, so we'll get that picture tomorrow, but let's look at September then. Are you expecting 25 basis points, or are you expecting a 50 basis point cut from the Fed?
I think they'll give us a 25 basis point cut, because the guys have indicated while the market was volatile, they pushed back most of the officials when it comes to 50 basis point cut. And some of them, even over the weekend, they pushed back even against increasing interest rates. So I think it's only fair to expect 25 basis points. But the good thing is, end of next week, we've got the Jackson Hole Symposium, where most central bankers will be meeting. And it's got a tendency to give market participants an indication of interest rate path going forward. So hopefully they will drop a hint when it comes to that Jackson Hole Symposium, which is happening end of next week.
So we've got Exxaro and Standard Bank due to publish their numbers. Which of the two earnings will you be paying close attention to, and why?
I think we'll look more into Standard Bank, not that Exxaro is not that important, but that will give us a clear indication of our economy, as we've seen with our job numbers that were not looking that great, as we've seen with our mining production numbers. And the banks are directly linked to the economy itself and how healthy the consumers are doing. And the biggest thing here is the issue of impairments. We know the guys have been doing great, making good money from the interest income. So we want to say that at the very same interest income, income is not starting to buy them, turning into impairments, because consumers and businesses probably are starting to struggle to make the necessary payments when it comes to those loans that were advanced to them.
So let's go back stateside for a bit. I mentioned in my intro that we've got, the likes of Walmart also due to release earnings. But let's look back at U.S. earnings season so far. What have we learned so far about corporate America?
It's starting to struggle. If you think about the previous earnings, that quarterly earnings, on average, they were up 11%, but the latest ones, they're up single digit. So it shows you that there's a time where consumers are starting to feel the pain and people have maybe depleted their reserves, because we know that the U.S. consumer being resilient is the one that has been also pushing inflation to go up. So of interest is to see that the struggling consumer is starting to feel the heat. How long can they be able to sustain themselves? So as we mentioned earlier with their retail numbers, the likes of Walmart as well is going to be a very good indicator when it comes to their numbers to see how sales are faring that side.
I'm glad you brought up the consumers, because I want to get your thoughts on South Africa's sort of general apparel retailers and as well as the food producers, given the fact that everyone is excited that we're getting closer and closer to this two-pot system. Interest rates might become a little bit lower. Inflation could come back into target. Your conviction on on those particular sectors?
People continue to start buying down, not just only on clothes or apparel, but also on food, meaning they're looking for value for money. Then you'll expect the guys who've got an exposure to the lower LSM, middle LSM, where we know that more than 50% of those people spend 50% of their money on food, to continue to do well. But as we're saying is that high LMM will still do okay, and those upper market, food retailers and apparels will be fine. But I think best interest should be, or the main focus should be, on the ones who are more focusing on the middle to lower LSM. As we said, that people are buying down, and then we know that people, when with the little money they have, they want to make sure that they extract as much value as they can. And it's not just only happening to food, to clothes only, it's also happening to food as well.
All right, Makwe, let's leave it there. Thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers.